Just a few years ago, artificial intelligence was perceived as a trendy tool for startups and big tech corporations. Today, it's transforming into a structural factor in the economy that influences the cost of electricity, chips, technology, labor, and even the policy decisions of central banks. Investors and economists increasingly ask the same question: will AI become a source of a new wave of inflation? Or conversely, will it help tame rising prices through increased productivity? To understand how artificial intelligence influences prices, we need to look at several levels simultaneously. What's happening with energy and electricity? How semiconductor and electronics markets are changing? How businesses are restructuring their investments and cost structures? How AI impacts wages, employment, and labor productivity? And finally, how central banks and financial markets are responding to all of this. The AI boom as a trigger for new costs. 2025 has already been called the breakthrough year for AI. Corporations and governments have poured trillions of dollars into models, data centers, and infrastructure. Some analysts estimate that cumulative capital expenditures on AI infrastructure could reach up to $4 trillion by 2030. This money doesn't appear out of nowhere. It goes toward building data centers, purchasing servers, GPUs, and memory, buying electricity and constructing new transmission lines, hiring and training specialized personnel. In the short term, such an investment boom inevitably creates price pressure in adjacent sectors. The greater the demand for chips, the higher the prices for semiconductors and memory. The more data centers, the higher the demand for electricity. The greater the demand for energy-intensive infrastructure, the stronger the pressure on utility bills for households and businesses. That's precisely why some economists and asset managers are already calling AI one of the most underestimated inflation risks for 2026. Electricity: how data centers are pulling prices up. One of the first noticeable effects is rising electricity tariffs. Energy agencies note that the demand for electricity from data centers is growing faster than power supply can keep up. Several countries have already recorded increases in retail electricity prices above general inflation rates, with experts directly linking this to the hysteria around AI data centers. Forecasts from the International Energy Agency and central bank research suggest that electricity consumption by data centers could grow by approximately 80% over 2022 to 2026. AI data centers alone could add about 90 terawatt-hours of consumption, which is comparable to several percentage points of current consumption in major economies. If demand growth outpaces the introduction of new capacity, we inevitably see rising wholesale electricity prices, increased infrastructure costs, substations, transmission lines, generation. And some of these expenses are passed on to the end consumer, to us. Some estimates show that due to increased load from data centers alone, gas and electricity prices in some regions could rise 7 to 9% above baseline projections. Chips, memory, and equipment: scarcity amid overheated demand. The second direct channel through which AI influences prices is the semiconductor and component market. The boom in demand for AI accelerators, GPUs, and server solutions has created a shortage of high-performance chips and RAM. Analysts warn that the frenzy around AI chips could lead to DRAM prices spiking by up to 70% compared to previous levels. When memory and component prices rise, this quickly transmits to server equipment for data centers, consumer electronics, smartphones, laptops, PCs. Consumer market forecasts already suggest that in 2026, electronics will continue to get more expensive, partly due to embedded AI features, memory shortages, and rising manufacturer costs. And here's the key point to understand: AI features provide added value to a product, so manufacturers can maintain a higher price. Component shortages and rising production costs further push prices upward. Together, this creates a sustained inflationary backdrop in the high-tech segment. How AI can accelerate overall inflation. Inflation isn't just about one specific product. It's about a general rise in prices across the economy. Why do investors think AI could trigger a renewed acceleration of inflation in 2026? There are several key factors. Scale of investment. The massive volume of capital flowing into AI, data centers, and energy infrastructure stimulates aggregate demand in the economy. This happens in parallel with government stimulus, especially in the US, Europe, and Japan. Monetary policy. Many central banks, after the peak of inflation, began rate-cutting cycles. However, if inflation accelerates again due to AI, they'll be forced to end the rate cuts ahead of schedule and return to tightening policy. Resource reallocation. Capital and productive capacity are flowing from other sectors into AI infrastructure, chips, energy, highly skilled workers. This can create shortages and price increases in adjacent sectors, from electronics to construction services. Thus, AI doesn't just make individual categories like chips or servers more expensive. It restructures the entire economy, creating new bottlenecks, places where scarcity didn't previously exist. The flip side, AI as an inflation-reducing factor. But the picture isn't uniformly negative. Most academic literature and economist forecasts suggest that in the medium term, AI is capable of reducing inflationary pressure through labor productivity gains. Some estimates suggest that AI could add 0.5 to 1 percentage point to annual productivity growth in developed economies. This means that with the same input costs, a company can produce more goods and services, and thus pricing pressure will be lower than without AI. Examples of effects that work toward reducing inflation. Automating routine operations reduces the need for certain staff. Optimizing logistics decreases transportation costs. More accurate demand forecasting reduces excess inventory and fire sales, stabilizing price dynamics. Lowering service sector costs, banking, insurance, consulting, allows for slower price growth. But there's an important caveat. The positive productivity effect materializes gradually as technologies are widely adopted. Meanwhile, the investment and infrastructure shock to prices hits in the near term. Therefore, in 2026 to 2027, the world might observe a situation where AI simultaneously pushes inflation upward through rising costs, while laying the groundwork for its decline in the more distant future. Impact on labor markets and wages. Artificial intelligence is changing not just electricity and equipment prices, but the labor market as well. This is another channel through which it influences inflation. Economists highlight several possible scenarios. Productivity growth and wage inflation restraint. If AI allows one employee to do the work of two, a company can pay a slightly higher salary, but to a smaller workforce. This reduces overall labor costs and can limit price increases. Shift in demand toward highly skilled labor. There's growing demand for developers, data scientists, engineers, and AI system architects. Their salaries are growing faster than the economy-wide average. This creates localized wage inflation in the tech sector. Regulatory and social effects. Mass automation could trigger political demands to protect jobs. Quotas, taxes on automation, basic income. Such measures often mean additional costs for business and can be passed through to prices. Again, there's no clear-cut conclusion. AI can both restrain general wage inflation through efficiency and locally accelerate it in shortage professions. Investor and central bank reactions. Financial markets are already factoring AI into their inflation scenarios. For 2026, several fund managers cite AI-related inflation as one of the most underestimated risks. Against the backdrop of government stimulus and surging AI infrastructure investment, they fear inflation might re-accelerate, forcing central banks to stop rate cuts sooner than planned. This creates several consequences: rising bond yields and more expensive borrowing, revaluation of high-tech stocks if profit expectations aren't met, capital migration from the overheated AI sector to more conservative assets, bonds, commodities, real estate. For central banks, the dilemma looks like this. On one hand, AI promises productivity gains and structural inflation reduction in the future. On the other, near-term overheating in energy, chips, and infrastructure is already pushing prices up. That's precisely why, in global economic outlooks, AI is increasingly described as a factor that will support inflation in the coming years, even if other shocks disappear. How AI changes price structure within companies. Usually, when we talk about inflation, we think of prices for food, gasoline, utilities. But companies first feel the impact of AI in their internal cost structure. Typically, a business's expenses are divided into energy and infrastructure, labor costs, rent and logistics, IT services and equipment, taxes and regulatory expenses. With AI's development, some of these cost blocks shift in relative importance. The share of computing resources, cloud services, and licensing grows. The share of manual labor in some processes, conversely, shrinks. For example, a banking company previously spent more on front office and verification departments, now invests significant resources in an AI platform that automates scoring, KYC, and document analysis. Bottom line, AI is expensive upfront, but if implemented correctly, it allows savings in other expense categories, and that's a matter of corporate management maturity. AI and prices in different industries, where pressure is strongest. It's important to understand that AI's impact on prices is uneven. Some industries gain advantages, while others face harsh increases in expenses. Fintech, banking, insurance. In these sectors, costs largely consist of information processing and decision-making. AI can radically cheapen scoring, transaction verification, and call center operations. Ultimately, the cost of many operations drops, and some of these savings could theoretically be passed to clients through lower commissions and fees. Manufacturing and logistics. Optimization algorithms for routes, shift planning, purchasing, and inventory management reduce waste, downtime, and excess stock. This is especially important amid high global inflation and expensive financing. Every ton of saved product or hour of truck idle time becomes additional margin protection. Media, content, marketing. Here, AI radically reduces the cost of producing text, images, video, and marketing creatives. Per-unit content cost falls dramatically, but competition for attention increases, so marketing budgets don't necessarily shrink. For end consumers, this might mean not price reductions, but improved quality and personalization of services at comparable rates. Heavy industry and raw materials. AI helps optimize extraction, predict equipment failures, reduce accidents. But AI accounts for a smaller share of expenses compared to raw materials, fuel, and logistics. So its impact on final prices is limited and often distributed across the supply chain. Thus, AI amplifies the gap between digital and traditional sectors. The former gain greater potential to cut costs and, if they choose, restrain prices. The risks of an AI bubble, and what happens to prices if it pops. A separate issue is the risk that the current AI investment boom turns out to be a bubble. Many economists compare the situation to the dot-com era. Capital expenditures are growing faster than proven business models and cash flows. If some AI projects fail to meet expectations, we could see capital beginning to exit the AI infrastructure sector, demand for chips, servers, data centers dropping sharply, prices for equipment and cloud resources potentially correcting downward. For inflation, this would mean short-term reduction in price pressure in the tech and energy segments, but also slower productivity gains if companies become more cautious about investing in new solutions. In other words, even if an AI bubble partially deflates, the world is unlikely to return to old price levels. Technologies are already embedded in business processes and infrastructure is built. Growth rates and cost increases might just slow down a bit. AI regulation and its price impact. Another underestimated channel of influence on prices is AI regulation. The EU, US, China, and other jurisdictions are already developing laws regarding transparency, responsible use, and data protection in AI applications. Any new regulatory layer means additional compliance checks, audits, legal accompaniment. For large corporations, this translates into increased legal and compliance costs, need to certify systems, conduct external audit checks, implementing additional protective mechanisms, monitoring, logging. For small and medium businesses, this could mean paid simplified solutions, off-the-shelf AI services with compliance already built in, subscribing to specialized platforms, which again brings us back to the topic of rising IT expenses. Ultimately, part of AI regulation costs end up in product and service price tags. That's another reason why technological progress doesn't automatically translate into falling prices for end consumers. What governments can do to mitigate the price impact of AI. Governments and regulators aren't passive in this story. They have several tools to smooth AI's inflationary effect. Investments in energy and network infrastructure. Accelerated construction of generation capacity, including renewables, and communication networks. This helps meet growing data center demand without excessively sharp tariff jumps for households. Supporting competition in cloud and chip markets. Antitrust measures and incentives for new players reduce the risk that a few giants can maintain inflated prices for computing power. Tax incentives, conditional on productivity growth. Stimulating companies that don't just spend money on AI, but can document cost reductions and job creation. Education and retraining. Mass training programs help ease social tension and smooth wage growth in shortage professions by expanding the supply of qualified workers. Such measures don't eliminate the structural impact of AI on prices, but they can make the transition smoother and more predictable. AI and price structure, the sectoral divide. Looking at different industries, we see that AI doesn't affect all price dynamics equally. Software and SaaS companies can pass efficiency gains to customers, lower subscription costs, or keep them as margin. Hardware manufacturers face rising component costs, but can leverage AI to optimize supply chains. Energy companies face demand shocks, but benefit from AI-optimized grid management. Traditional retail experiences pressure from e-commerce enablers using AI, yet benefits from inventory optimization. This creates a complex ecosystem where some prices fall, others rise, and the net effect on consumer inflation depends heavily on market structure and competitive dynamics. Final emphasis for the listener. If we step back and look at the big picture, artificial intelligence is a new layer of the economy that simultaneously increases demand for energy, chips, infrastructure, and talent, raises capital and operating expenses for companies, provides powerful tools for cutting costs, automating operations, and boosting productivity. For ordinary people, this means that in the coming years, some bills, electricity, tech equipment, digital services, will face upward pressure. At the same time, Many services will become smarter, faster, and more personalized. The level of competition among AI-using companies could be the deciding factor in whether we see real price reductions or just higher quality for the same money. And that's precisely why the conversation about AI has long since moved beyond IT circles. It's a conversation about how much it will cost to live, work, and do business in a new economy where models and data centers become as important as oil, gas, and steel. Conclusion: the AI inflation puzzle. In 2026, the world faces a paradox. The technology that promises long-term efficiency and lower costs is simultaneously driving up prices in the short term. This isn't a reason for panic, but it is a reason for careful attention. For investors, it means pricing in near-term inflation risks while maintaining faith in long-term productivity gains. Diversifying across sectors affected differently by AI adoption. For businesses, it means investing in AI isn't optional. Companies that fail to adopt will lose competitive advantage. But the investment must be paired with strategic cost restructuring to realize returns. For policymakers, it means balancing support for innovation with attention to price stability, ensuring that infrastructure can scale with demand, managing social transitions as AI reshapes labor markets. For consumers, it means understanding that some price increases are structural and temporary, preparing for a transition period where efficiency gains take years to materialize, benefiting from improved services even if some nominal prices rise. The influence of artificial intelligence on prices in 2026 won't be a simple story of inflation or deflation. It will be a complex, multifaceted transformation that affects different parts of the economy at different speeds and in different directions. Understanding these dynamics and preparing for them will be one of the key economic challenges of the next few years.